Hi everyone, welcome to PDS Strategies Lesson 5. This lesson is divided into two parts. The first is on the combined spread strategy, and the second part is on money management and compounding principles for all PDS trader strategies. Now, part one with the combined spread strategy, that's really a combination. It's exactly what it sounds like. It's a combined strategy of a couple of strategies that we've already learned, and I was really hoping that before this lesson was released we would have the availability to find these combined spread strategies or spread opportunities on the PDS Trader. That did not happen. Probably not going to happen until the end of June, maybe early July-ish, and we're working on some other things with PDS Trader. Mainly the tracking is what we're really working hard at getting. It's going to blow your mind what this tracking will do. It really adds a lot of value to what we already have with PDS Trader. So we're going to get that squared away, and we have one other feature that I won't mention squared away, and then we're going to be able to add the combined spread strategy. You can still find the opportunities through PDS Trader. It takes two steps basically, as opposed to PDS Trader doing everything for you at once. But nonetheless, it is the last strategy in these series of lessons, and it is really something that you probably don't want to get involved with too much until you have a really good comfort level with the other strategies anyway. It does require a little bit more attention, and you'll see why here as we go through it. The first part of the combined spread strategy, uses a vertical spread. And of course, if you'll recall, a vertical spread is simply a spread between two options with the same expiration already gone over, but this is the first type of strategy that is used in the combined strategy, and it is a vertical credit spread as a general rule. Sell the near, strike, buy the far. Then the other half is more or less a debit calendar spread. An example there, sold STX 28 call November 2nd expiration at 124 and bought STX 28 call November 16th expiration at 137. So the debit calendar spread sells the near expiration, buys the far expiration, but same strike. So creating a net debit. So those are the two strategies that we're going to combine together and try and optimize the opportunities that are available through the weekly options. Now, we're going to combine these two together, and we're going to attempt to create a net credit as a general rule. We'll talk about a combined spread strategy with a net debit, but the main focus is to create a net credit. And this can also be considered a diagonal spread. If you're familiar with option spreads and some terminology, this can be considered a diagonal spread. The difference, though, is that we have a different goal. Our goal is to exploit the diagonal spread concept through multiple weekly expirations of one of the legs. Okay, so essentially what's going to happen is we're going to buy an option, and then we're going to sell another option several times against it. And that's essentially what the diagonal spread is going to provide us. So, for example, KCG. KCG, sell the 12/22/12 350 put, and we're going to buy the 119.13 $3 put. Okay, so in this we have both a different expiration and a different strike. That's what's considered a combined spread strategy. Different expiration and different strike. And as you can see here, we can sell the 12/22 350 put at about 20, and we can buy the 119 $3 put for about 10. Okay, so that's we're creating a net credit of 0.10. here's what it looks like. Sell the KCG 12/22/13 expiration 350 put for 20. Buy the KCG 1/19/13 expiration $3 put for 10, and you create a net credit of 10. Okay, so both the expiration and the strike are different. And here is the general rule. Sell the near expiration and strike, buy the far expiration and strike. Okay, so you're always selling what's closer to you, both in expiration and strike, and you're always buying what's further away from you, both in expiration and in strike. So it's very simple to remember what you're trying to do from that standpoint, because you're always selling the near, strike, and expiration. You're always buying the far, strike, and expiration. Okay, so on this example, KCG was trading at 349 at the time, and there were 5 trading days left on the 12/22/13 expiration option. So what happens with this particular spread? How does this work? What are the risks? What has to happen to make money? What's the goal? Those are all of the questions that we're going to be answering as we go through this example. So if KCG closes on 12/22, the expiration of the short option, if KCG closes at 350 or higher in that 5-day period, then you make 20 cents on the short put, period. You will make 20 cents on the short put if it closes at 350 or higher. If it closes at 350 or higher on the long put, you will lose something, most likely less than the 10 cents that you paid on the long put. So your worst case scenario here is that you make 10 cents on this if it closes at 350 or higher. Okay, so the best case scenario is that it closes at 350 and no value is lost from the long put, and you make the entire 20 cents during that first entry. Okay, but we're not looking only at the first entry, so it really isn't going to make that much of a difference. And there is a possibility, if the market skyrockets during that 5-day period of the first entry, that the $3 put becomes worthless. But that doesn't change what we're able to do, because we're already considering that we're going to take the entire loss on that at the end, by the end of expiration, because we don't have to get rid of it, right? We don't have to exit it. There's no reason for us to exit it. So even if KCG skyrockets the first week and the long put becomes worthless, we can just hold on to it. And if it comes back, great. If it doesn't, we still made money on that. So it's and then if we're not able to sell the next one, which is what we're fixing to get into, if we're not able to sell the next expiration against that long because the market skyrocketed, then we still made money on that. So there are some benefits to this, definite benefits to this, even if you only are able to sell the spread once. Now, the max profit potential with the first entry is 20 cents. So that's assuming that you make the entire 20 cents off of the short expiration and that you don't lose anything from the long expiration. So if you were to exit both legs, the max profit potential is 20 cents and you're done. Now the max loss potential is 40 cents. So even though we're creating a credit in this, there is a chance that the loss can be bigger than your max profit potential on that first entry. Now, it is limited. Your loss is limited. So it is a benefit of the combined spread that risks are absolutely limited and controlled. So you're not going to get into this and get into a situation where you suffer a bigger loss than you were hoping to, etc. So, once the short option expires, either the long option gains after that or it loses, and the amount that it loses is absolutely capped. So, your max potential loss is at 40 cents, and that's at a close of $3 or less. So, if KCG closes at 3 in that 5-day, in that first entry period, if it closes at 3 on 12/22, then you lose 30 cents on the short put. Remember, you brought in 20 cents, and the difference is 50 cents, so your loss on that short put would be 30 cents. And then you would also lose the 10 cents on the long put, so that makes it 40 cents total. If it goes down to zero, you're still only going to lose 40 cents because at that point your long put is making up any loss for your short put. Of course, your long put at that point, if the market continues to go down, then you actually have the chance of making that back or mitigating the loss or even making money. So if KCG closes at 3 on 12/22, you may lose 40 cents essentially on paper, but because that long option is still out there, and at 3 it's definitely going to be worth more, you actually may see in your actual trade, as opposed to just looking at the worst case possible scenario on paper, but in actuality, that $3 put, because it still has 3 weeks left to go, is going to be worth something more than 10. And if you want to know about what it's going to be worth, you can look at the 350 put around the same strike, or excuse me, at the same expiration. You're going to get a good idea of about what that's going to be worth at the money if the market moves down. And so your loss in this particular situation is going to be something less than 40 in all likelihood. So you are looking at a very high probability of seeing something less than that. And if we want to look at that, by the way, let me see if I have this on here. The 350 put 119 expiration was trading at 30. Okay, so that would be at the money. So if the market moved down to 3 on 12/22, then what you're looking at is that increasing by 20. So you lose 30 on the short put and you gain 20 on the long put, and your actual loss is actually 10 cents and not 40 if on 12/22 the market closes at 3. So we are looking at the worst case scenario here, and that is the max loss potential, but there's a very, very, very high probability that you will not suffer the max loss if the market does move against you during that first week. So there's a great benefit with that, knowing that even though your max loss is 2-1, even if it moves against you, you have a very solid chance that it's going to be much less than what that max loss potential really is. So that's essentially what we're looking to do with the first entry, what we are looking for with the first entry. And of course, if you hold on to that long put and you don't sell another option against it, then by the time it expires, then you're looking at the potential max loss. So if you find yourself in this situation, you either want to go ahead and get out and only take the small loss, or you want to make sure that you can sell another option, and that's essentially what we're trying to do. Okay, so on 12/22, let's say KCG closes at 350. You make between 10 and 20 on that particular spread, but then you turn around and you sell the 12/28 expiration 350 put, probably for around another 20. Now remember, the weekly options don't deteriorate with each new weekly options because there's the same amount of time on them, 8 days, 7 days. So if you were to sell one option for 20, one weekly option for 20, you should be able to sell the next option for 20, and then the next weekly option for 20, all the way up to the long expiration of the long put or call if you're in a call spread. So with this, you can be very consistent. Now there are some possibilities that will not be the case. For example, if you have earnings one week and then not earnings the next week, or the market's already made a move, or the market made a move due to some sort of news, so it changes the value of those options, then you may not be able to bring in those. So you might want to look at earnings releases and when those are. because you know that the options, the weekly options, are going to keep their high value if there's something pending in the future. But after that, then they're probably going to lose the value. So you might want to keep an eye on that and make adjustments to what your projections are with these sells. So if KCG closes at around 350, you make between 10 and 20, and then you turn around and you sell another expiration, a 350 expiration for another 20. This means that you bring in another 20. You've already brought in another 20. That means you've brought in a total premium sold of 40 cents. So what does that mean? Well, that means that once this closes out, you cannot lose money on this trade again. So any additional sell is pure profit. It becomes a risk-free trade. And for all intents and purposes, because your loss on the previous one, if the market did move down to 3, was only 10, for all intents and purposes, on a practical scale, you're probably looking at a risk-free trade, even if on this second expiration the market does move down to the strike price, because there's still going to be value on that $3 put. So essentially, once you get to that second sell in this type of situation, so it was a credit spread and it was a 2-to-1 risk-loss ratio. Once you get to that second sell, you're basically almost assuredly securing a risk-free trade. And of course, if the risk to reward ratio is a little bit different, then that may change. If you're not able to bring in 20 on the next one, that may change a little bit. So there are, some slight moving variables in this, but you get the concept, you get the idea. That's what we're going for. So we get the second sell. We've brought in 40 cents premium at this point. And on the expiration of 12/28, if that expires, that means we've brought in 40 cents. And if we sell another one, we cannot lose with that one, period. Even if we hold on to the long put until expiration and expires worthless. Okay, so here's the concept. We sell the 12/22 expiration 350 put for 20. We sell the 12/28 expiration 350 put for 20. We sell the 1/4 expiration 350 put for 20, and we sell the 1/11 expiration 350 put for 20. So we bring in a total of 80 cents in premium, and then of course we've held on to this long $3 put from 10 cents, so that gives us a total net credit of 70 cents. And that's essentially the best you can hope for. Now, on some of these, of course, this is assuming that the market stays at 350 for all these expirations. And of course, that's not going to happen. So that's why we talk about looking at the first one and making sure that the first one meets the criteria. If the first one doesn't meet the criteria, don't count on these. You cannot count on those. We want to make sure that the first one meets the criteria. That gives us a higher probability with these other ones, especially if it turns out that we can't, we aren't able to sell these other ones against that long put. So we sell this, and this is what makes this different than just a normal diagonal spread. The weekly options change things. It changes what we're doing. It changes the whole dynamics of the diagonal spread, because we're able to hold on to one long position, one transaction on a long, and we're able to make multiple sells against it, utilizing the best time period that options decay, which is, of course, the last week or 2 weeks, and in this case, the last 7 or 8 days. So it's the best of all possible worlds, but you still have to make sure the numbers meet the minimum criteria, because you may not be able to sell a 350 put on this third. It may drop down to 3, and you may not be able to do anything except just go ahead and exit the spread. So you want to make sure that you have the highest probability of success with the first one, and then the highest probability of success with the second one, and then you just keep on going down the road. Now, if you have success with the first one, and then you get to the point where, okay, let's say for whatever reason the 350 put, the 12/28 expiration 350 put is only trading for 5. Whatever, something deflated the values of the puts. Then you just take your money and you walk. I mean, you go ahead and you exit the $3 put if it's worth anything. If it's not, then just hold on to it because there's no reason to exit it. But if it is, you can just take your money and walk and go look for the next opportunity. So the great thing is that once you find a good opportunity for that first entry, you just stick with it, and it's very easy from that point to know what you're looking for because you're already long one of the puts as the ultimate protection. So you bring in a maximum potential profit of a net credit of 70 cents if you're able to successfully sell each of these option strikes. And if you're not, you still have a very high probability of success. The only way that you lose money is if early on the market tanks and you ultimately end up losing, hopefully something less than your maximum loss. Now, if it tanks too much, by the way, you will lose the premium on all of that, all the extrinsic value. So, for example, if it tanks, let's say it goes from 350 to 1 on 1222, that's an instance where your put option is going to lose all extrinsic value. So you will lose the entire 40 cents in that scenario. So the only way you lose the entire 40 cents or the entire maximum risk is if you have a massive, massive, massive drop. That's it. Other than that, you have every opportunity to not suffer that maximum loss. So it's a very high probability that you don't suffer that max loss, and it all sets up with that first entry. And then there may be some instances where the 350 put may be slightly in the money, and you might actually bring in more than that. Now, there's going to be some intrinsic value, but if it moves back up above 350, that just increases your profit potential. But you want to look at the extrinsic value, and that's really what you want to do. Because if you sell this 350 and let's say it's trading at 340, and you bring in 25 cents for that 350 put, the extrinsic value in that is actually only 15 cents. And what happens is if the KCG closes at 340 on that 1228 expiration, you're going to get assigned. So you have to be aware that that you're looking at the extrinsic value, and you're looking at the potential of being assigned a position based on that, and you have to account for that. If it looks like you're going to be assigned, as a general rule, I would just look to exit the option as opposed to dealing with being assigned. There is, of course, a strategy that you can utilize so that if you are assigned, that it's something that you can try and manipulate a bit, but you want to be careful with that. So you just got to make sure you have the strategy in place of what you want to do with that long or short position, depending on whether you're in a call or a put spread. So most of the time, you're not going to be able to get that net credit of 70. If you were, that brings in, if you're able to successfully do this whole deal, then that brings in the potential, a very high probability of success, number one, and it also makes it to where you have a very, very high probability that your wins are going to be larger than your losses in the long run. So you have the best of both worlds in that area as well. Even though the maximum risk is greater than your profit potential on that first entry, the probability is you don't realize it. So in the long run, you have a positive risk-reward ratio, and you have a definitely a positive probability of success because of all the different scenarios that can happen, and you still make money with this particular spread. Okay, now here's just a quick summary of the benefits and the drawbacks. The benefits are limited risk trades. You have a high probability of success. They can quickly become risk-free trades or very little risk very little risk trades. It requires only a little capital because you are covered. Therefore, your capital requirements are based on what your max risk is. And you can take advantage of premium decay multiple times while only having one leg, basically a single purchase of that purchase leg during the time that you're making the selling the different options on the different expirations, weekly expirations. Okay, so a lot of benefits with trading this type of spread. The drawbacks are the risk-reward ratio is slightly skewed on the first one. So if you have a series of trades where you somehow just bottom out on a bunch of trades on the first time you implement this, there is a little bit of a skewed risk-reward ratio. And of course, you make that choice of whether you take the trade or not. And then there's the potential of not reselling the weekly options, so your profit potential may be a little bit smaller than what you hope for. So that's certainly a drawback, but it's not a huge drawback. And then the biggest drawback is that they're not very easy to find. It takes a little bit of work, even with PDS Trader. It takes a little bit of work right now. That's why I really wanted PDS Trader to be able to do this by the time this was released, but it doesn't yet. Like I said, it's probably going to be end of June, maybe July-ish before that's in there, but you can still find the opportunities by looking at the best vertical spreads and the best debit spreads and combine the two. Okay. Now here's another example, and we're going to talk about this on a debit basis. So we sell DDD weekly 33 puts for $1.15, and we buy the DDD monthly 30 puts for $1.35. Now, what's different about this than the example that we just gave? Well, this creates a net debit, and there is nothing different about what you did. Okay, the numbers didn't match up. We're still selling the nearby strike at this point. I think the DDD was selling for around 34. Okay, and yes, you can do these out of the money if the numbers match up. Obviously, the closer to at the money, the better off you're probably going to see the numbers and the profit potential. Okay, but if you look at the DDD weekly puts, brought in 115, you bought the further away strike and expiration, but you still had to pay more than what you brought in for the closer strike and expiration. So that creates a net debit. So you don't do anything different to create a net credit or a net debit. It's just that the numbers for that particular situation don't pan out. So the max risk, of course, is the strike difference plus the debit on these. So the strike difference is 3 plus the debit. So your risk on this particular trade is $3.20. It's a lot different than 40 cents than with what we saw with KCG, and the max profit potential is only 115. Okay, so on KCG, the max profit potential was bigger than, the 1 week max profit potential was bigger than the amount that we brought in, which was, or that we paid out, which was 10. On this, it's not. So now we have a big skew here. So the risk-reward ratio is 2.78 to 1. It would take 3 sells to guarantee a risk-free trade on this. Okay, so this is an example of why a debit combined spread probably not a great idea. Simply because the probability of ultimate success is dramatically decreased, and it's dramatically decreased because you can't make money on that first one. Or let me rephrase that. You can, but you're really hoping that that further away put doesn't lose value. And you got to remember that further away puts will lose value faster as you grow closer to it. So that further away put, very realistic that the market stays the same, and the further away put loses as much as you gained on the sell option. So you got to be aware of that. Strongly suggest that you try and look for the credits on the first time. If it's a debit on the first time, just pass and go on to the next one. So then also, if DDD skyrockets and the 30 puts become almost worthless, then the net debit could yield a loss on the first entry when the market went in your favor. All right, so if you create a credit with these combined spreads, if the market goes in your favor, you make money. You may not be able to sell the extra weekly options, but you still made money on that first one. So in this, if you create a net debit and the market goes in your favor, you could still lose. So I don't like doing that. It just decreases the probability and doesn't give me enough opportunities of different types of market conditions and circumstances to still make me money. So that's my 2 cents worth on the net debit creds. Net debit spreads. Sorry. So, in summary, the best setups are ones where the first entry creates a credit and the risk-reward ratio is around 2 to 1 or better. And that's with the first entry. If you can find those are the ones that you want to investigate and look into and possibly trade. Okay? Now, one note on this before we move on. If there are only a few weeks left on the monthly option, you may not want to implement this as a first entry on a particular spread. So let's say you don't get the 1222, you don't get the 1228, you don't get the 1.4. Let's say you're now looking at 111, and this is your first entry. There's only one expiration on that. Now, if it creates a net credit, great, but there's only one expiration, so you don't have a lot of potential to sell multiple expirations against that one purchase. So you may want to look at the potential of going out to the next month before the closest month expiration expires. There is that possibility because you can turn around and sell a weekly and then sell the closer monthly and then sell the weekly and so forth and so forth. Or you can start with selling the closer month versus the further month and then go to the weeklies after that. So if you find that if you find that's the situation, you want to look at opportunities for the next month. Now, obviously, the further away you get, the harder it is to find the opportunities that meet your criteria. So the entry is really around the expiration of the monthly option versus the next monthly, and that's ultimately the best time for you to take advantage of these, so that you have 4 weekly option expirations before the next monthly. You can do it with 3. You just need to make sure that that the numbers square. Okay. So hope you enjoy that. Again, it'll be really great once we implement this into PDS, but you still have the ability through PDS to find these types of opportunities. And then once you find one, so you're basically looking in a certain time period of each month. But once you find a few, then you don't have to find any more because you're going to play those all the way until the next opportunity, best opportunity time period arrives. Okay. So that ends part 1. Part 2, we're going to completely shift gears, and we're going to look at money management principles that can be applied to any strategy, and certainly can be applied to each of the strategies that you've learned in these lessons. Now, I will make a preface statement that money management principles, people get caught up on, okay, well, how do I apply it to this strategy? And how do I apply it to this strategy? Or how do I apply it to that strategy? And if you understand the principles, then you can apply the strategy, the money management strategy, if you will, to any other entry and exit strategy. Okay, there really is no difference once you understand the principles. So it would be impossible for me to give you specific money management application for each strategy in the PDS Trader because we're dealing with numbers. Okay, you're dealing with numbers. It doesn't matter where those numbers were derived. What matters is what you do with those numbers. Okay, so all strategies break down into stats, basically performance stats. You have a win-loss ratio, you have a probability, you have a max risk, potential risk, you have an average risk, you have an average profit potential, you have a max profit potential. You have all these stats, right? So it's all numbers. Well, we're going to take some of those numbers, and we're going to look at those numbers and know how to apply the money management based on those numbers, not the strategy. Okay, you can have two very similar numbers from very different strategies, but you're going to apply basically the same money management strategy to both of them. So it doesn't matter whether you're a debit credit or a debit calendar spread, or a credit calendar spread, or a debit vertical spread, or a credit vertical spread, or a combined spread, or a covered call. It doesn't matter. You're looking at the numbers and you're making the money management decision based on those numbers. Put out of your mind the fact that, okay, well, this strategy needs a different money management approach. Not true. It needs a money management approach based on the principles that are given according to the stats of that strategy. Okay, so money management strategy is the same for all, just different variables. And some people have a hard time narrowing it down to that, but that's the way it is. It is based on numbers, not strategy name or strategy type. Okay, so having said that, I will look at a couple of different categories because basically the first focus is the risk. But before I get to those categories and I kind of explain that further, people ask me, why do you pay so much attention to money management? Of course, I've written a book on it. I have a 12-hour course, which I'll mention again here later in this lesson. I have a 12-hour course on money management. Why do I pay attention to money management so much? Well, here's why. Let's say you start out with a 5K trading account, trading only debit spreads, and you're risking no more than around $150 a week. That's what you've decided, that I don't want to risk more than $150 per week. Worst case scenario, trading debit spreads in a 5K account. So you average around, let's say you average around $300 in profits per month. So you're successfully trading these. Obviously, if you're risking $150 per week, the way we trade debit spreads, you're looking at around 100% return on the successful trades on average. That's what you're kind of going for. So you have a max profit potential of around $600 a month. So of course you're probably not going to do that. You're not going to make your max profit potential. So we'll say you average around $300 profits per month. And that's it. Well, after 5 years using a proper money management, in fact, I'm going to use the exact one that we show today, your $5,000 after 5 years grows to $545,000. Okay? Money management will dramatically increase your overall profit potential of any strategy that you trade. Now, if you did not use money management during that 5-year period, your $5,000 would only grow to $23,000. That's it. So you're looking at a massive, massive increase in your profit potential, and you're essentially not increasing your overall risk when you apply the money management. This is why you're exploiting the profit potential without increasing your initial risk. It is absolutely a major, major mistake to not focus on money management. This is why I hammer on survival. Your first goal should be survival. And you know why it should be survival? Because money management, if you survive, the money management potential that money management gives you is just astronomical. So while everyone else is looking for the holy grail on the entry and the exit and wanting to be continually profitable, consistently profitable, always profitable. They don't want to go through drawdowns. They don't want to go through slow periods. They don't want to go through stagnant periods. That's the focus of most everybody in the trading industry. Then they make their decisions on profit, not risk. Okay? If you focus on risk and wait for the profit to come and then apply the money management, you're going to be far better off than 99% of all the other traders. So let's say I tread water for a year. Okay? What happens if you tread water for a year in a strategy? Realistically, have you ever traded a strategy for an entire year and not made money with it and continued to trade it? Most of you probably have not. Most of you quit long before, right? But let's say I tread water for a year, but I never come close to the maximum expected risk of a strategy. You know what I do? I keep trading it as a general rule. Then finally, after a year, the strategy resumes a profitable run. What happens? Well, my 5,000 allocation after 1 year is slightly lower, let's say at 4,700. But then the following 3 years, it produces the expected average return of only $300 a month based on a single trade size per spread. Debit spreads, remember. So after 4 years, my $5,000 grows to $350,600 approximately. Meanwhile, everyone else quit trading 6 months into the strategy. Not because it hit their maximum risk, but because they weren't patient enough. So listen, all strategies go through slow periods. All strategies go through periods of stagnation. As long as it doesn't hit my maximum risk, then I'm going to look at committing to it for at least a year. If I've done my due diligence and my homework and I haven't somehow blinded myself to what the realistic expectations are with a strategy, then I'm going to commit to it for at least a year, because I know that my money management is going to give that potential, just huge potential to that. So that's kind of my soapbox on that. But nonetheless, as long as the strategy does not breach my risk tolerance level, then if the money management dictates, then I stick with it, and that's my MO on trading, and that's how I strongly suggest that traders look at this. Now, the only other difference, and by the way, if a strategy does hit my max risk, I will not trade it any further. So, I do have an uncle point, but I make sure that I commit up to that maximum risk. Now, the only difference, or the only situation where that might not be the case, is where I am trading several strategies, and these other strategies are doing very well, and I need to allocate the money that I had with this other strategy that's stagnant and push it over into these other strategies. So, in other words, I find something that gives me a higher probability of success or provides more evidence that it will be successful. And if that's the case, then I may not fall through the commitment, but I'm very slow to change. I have to have very solid evidence that the one I'm looking at is going to, or has a very high probability of doing better than the one I have the money allocated to before I move that allocation. Okay? So, having said that, let's get into it. I will divide how the money management strategy is applied into two different categories. And the only reason I'm doing this is not because you change the money management principles, but because I want you to focus on the risk. The limited risk strategies and then the non-limited risk strategies. Remember, it's the same money management strategy, but you just have different variables. So one variable is being aggressive with your money management, and the other variable is being conservative with your money management. And you need to consider being more conservative with non-limited risk strategies. You have to take the fact that you have, in theory, non-limited risk strategies. Therefore, your maximum potential loss in that strategy is bigger. So we're going to look at the strategies that we've gone through in these courses. The first, limited risk strategies would be considered debit calendar spreads, credit calendar spreads as long as you exit properly, vertical spreads, debit and credit, and then the combo spreads. So all of those are limited risk strategies. So you can be a little more aggressive because you have a finite, concrete, solid idea of what your max risk is with each of those strategies. Now, a non-limited risk strategy would be a covered call or a synthetic covered call, or selling puts. And they are limited in risk. Obviously, stock can't go negative, but we're obviously not accounting for every trade potentially going to zero. So it's a little bit harder to define the maximum risk with these, and that's really what I'm looking at is strategies that are easier to define the maximum risk versus strategies that are harder to define the maximum risk. And if it's harder to define the maximum risk, you want to be more conservative with the money management. That's the only reason. Same strategy, but it's the only reason that I divide those into categories. Okay? So, first, limited risk strategies. First question is, how much risk capital will be applied to each strategy? That's where we start. How much are you going to be risking in that strategy? How much are you allocating? And for the purposes of this lesson, whatever you allocate is what you're risking. That's simply what we're. That's how we're going to define those terms. Okay, so allocation is risk. Survival is always the first goal in trading and is a money management based decision. So if I'm trading in debit calendar spreads and have $5,000 of risk capital to allocate, and I choose to take a maximum of 4 or 5 debit spreads per week, or risk no more than $150 per week. So I may have 2 debit spreads where the debits are $50 a piece, or 3 debit spreads where the debits are $50 a piece, and that brings me up to my maximum $150 per week. So 4 or 5 debit spreads, maximum risk $150 per week. How long will it take me in that situation to lose $5,000 if I lose the maximum risk on every single one? That's the question you have to ask. Okay, that's where you start from. That's the starting point of all proper money management, is what is the maximum risk? What's the probability of the maximum risk? And that's something that we get into, and you have to do a little bit of analysis. But the answer is 33 weeks, or about 8 months. So if you place a debit spread, 4 or 5 debit spreads, let's say on average, risking no more than $150 a week, if you were to lose on every single one of them, it would take you 8 months to lose $5,000. Okay? So how much would I lose in 1 month? $600. Are these two things acceptable? What's the probability of seeing all of your debit spreads lose the maximum risk for 8 months? Very, very, very small. But if that's acceptable to you, if you're willing to take that risk, then you probably have a very solid starting point of what you want to allocate. If then you break it down to something closer. If you were to lose every trade in 1 month, and so your $5,000 loses $600, is that acceptable? That has a little bit higher probability. You can have a bad month where every single trade loses. Probably not the maximum loss, but certainly, there is a higher probability of that happening than for it to happen for another 8 months. So you have to look at that and you say, okay, is that acceptable? Will I be able to continue trading that? Those are the questions that you have to ask. So you focus on the worst case scenario, and if it's acceptable, then you have a good idea of where you want to start. And if it's not acceptable, then you need to lower your allocation. It's as simple as that. So we already know, again, that with debit calendar spreads, that the profit potential is about 100% per trade on a risk being taken. So after you have looked at the risk potential and after you have taken in all that into consideration, you look at the max or your max profit expectation, and then you look at the realistic expectation of profit potential if it does well. And in this particular situation, because we already know that debit calendar spreads we're going for about 100% return on a per trade basis. So if we were to win on every single one of them, we would make about $600 a month. So just like we're probably not going to lose $600 in a month, we're probably not going to make $600 in a month either. There is the potential though, because some of these there is a potential to make more than 100%. You can make 200, 300. I've made as much as 400% on a debit calendar spread, on a single debit calendar spread. So, there is actually the chance of making the 600 or exceeding the 600 because it's not a set number, but the loss is a set number. Remember, that's a limited risk, so it is a set number. So we're going to assume that we don't make $600 a month. We're going to assume that we make, on average, around half of that. Okay, so we lose on some trades. We make 100% on some trades. We make more than 100% on a few trades, and we make less than 100% on a few trades. It averages out, we're going to say, around $300 per month. So now we have our stats. We know what our expected 1 month loss is. That's what we're going to base our increase on, our rate of increase. It's called the delta. We're going to take that maximum, worst case, everything loses in 1 month. What happens? We lose $600, and we're going to take that and we're going to plug it into a formula. And it's a very simple formula. So there's nothing complex about this. It's very simple. But you cut this max loss in half of 1 month maximum. You lose everything. You cut that in half, and you plug it into this formula. And you say the trade size equals previous trade size times 300 plus previous equity. Okay, so if you're just starting out, what's your previous trade size? Well, it's 1. And we already know we plugged in the 300 into that slot. That's called our delta. And then we add the previous equity, and if the previous equity is our starting equity, that's 5,000, right? So it's 1 times 3,000 plus 5,000, and that equals 5,300. Well, that's when we start trading 2 spreads per position, okay, at 5,300. Once we have closed equity of 5,300, we begin taking 2 spreads per position. So we're doubling our risk at that point. So what happens in that week? We have a debit calendar spread, and in that week we end up losing every single trade. Well, the maximum risk is $150 based on a single spread, so it would be $300 based on 2 spreads. So it is possible that after 1 week you suffer the maximum loss on every single trade and you drop back down to 5,000. Well, guess what? That just means you go back to 1 spread the following week. Okay, so that's how it works out. So here's the table. If you were to apply that strategy all the way down, then at 5,300 you go to 2 spreads per trade. At 5,900 or above you go to 3 spreads per trade. At 6,800 you go to 4 spreads per trade. At 8,000 you go to 5, etc., etc. You get the idea. Now, remember we said that we should average around $300 a month in profits. Well, that means that we should average increasing trade size about once a month. So these, after 12, we can kind of get an idea of where we're going to be at the end of 1 year, because of the average profit on a monthly basis is the same thing as our delta. And if our delta was half of our average profit, then that just simply means it'd be 1 increase about every 2 months. If it's double, that means we'd see an increase about once every 2 weeks. So you can make that calculation and kind of estimate time-wise based on the relation of your average profit versus to the delta, which is this number right here. And you can make a time estimation. That's how I know that after 5 years, if I average $300 a month, after 5 years, my account is going to be well into the $500,000 area. Okay, that's how I can do that. So, our increased size, current trade size times 300 plus previous equity, gives us those levels. Those are also our decrease levels. And so if you suffer drawdowns, let's say you go to 6, you're at 9,700, and you go to 6, and then that week you suffer a drawdown, you go back down to, let's say, 8,500. Well, then on the next set of trades, you drop down to five spreads per trade, or excuse me, five spreads per trade. That's correct language. Okay, so that's how that works. Very, very simple. Here's that table by the end of 5 years. 536 after this month. If you average $300 per position, you're trading 60 positions per trade, you will have $554,000 in the account. That's approximate. That's going to change slightly based on how many times you went into a drawdown and had to decrease trade size. So it might, these are approximate estimations. It's going to change slightly. You're not going to make exactly $300 every month. Some months you may make $250. Some months you may make $500. Some months you may make something less. Some months you may lose. So we're talking about approximations and estimations based on averages. And that's essentially what we're looking at there. Okay? Now, if you do average 300 a month and you don't have excessive decreases, you will be very close to this number at the end of 5 years. That's how the numbers work. You cannot not do it that way. So it cannot not happen. In other words, it's not hypothetical. It is what it is, and the numbers work out no matter how it gets there. So once you have established the increase level, and we establish the increase level by looking at the maximum risk on a single month basis, we cut that in half and then we plug that into the formula. So once we establish an increase level and we create our table, then we do another risk analysis. And this is important because you need to know what's going on if you suffer that massive loss or massive drawdown after you've already made several increases. Okay, so at $5,300, you increase to risking $300 per week. What happens if all your trades lose that week and you drop the maximum loss and your account drops back to $5,000? Are you okay with that? That's the question. Okay, your risk analysis is, okay, if I suffer the maximum loss at this point and my account drops down to this, am I okay with that? That's the only question you're asking yourself. And if you are, then great, you've got your money management strategy. If you're not, you probably need to be a little more conservative. And I'll touch on that. Okay, so then what if you have 10 increases and then suffer a bad loss? Are you comfortable with that risk? Okay, so let's say you've made 10 increases. You're now trading 10 spreads per trade. Your account grows from $5,000 to $18,500. Okay, so above $18,500, you're making 10 spreads per trade. If all your spreads lose that following week, so it's $150 per spread, and you're trading 10, you're looking at a $1,500 loss, and your account drops from $18,500 down to $17,000. And now you're trading 9 spreads per position. Are you comfortable with potentially taking a $1,500 hit in a single week based on that increased table? If you are, then you've found your variables. You've got your variables set. If you're not, then you may want to be a little bit more conservative. Okay, what if you lose all your trades for a month after reaching the 10 lot level? You have to ask yourself that question. Well, week 1 drops to 17,000. Week 2 drops to 15,650. Week 3 drops to 13,450, and week 4 drops to about 12,400. This is a disaster month. You drop from 18,500 to 12,500. Are you comfortable with that? Well, that's what you have to ask yourself. Some may be, some may not be. What's the reality? What's the realistic possibility of this happening? It depends on the strategy. Depends on how well you've done your homework on determining the probabilities. But for debit calendar spreads, it's possible that you lose on all your trades in a month. Probably not very probable that you lose on all of them, and when you do, that you lose the maximum risk, but it is possible. So that's what you're looking at. Here's a disaster month. Are you comfortable with that? Well, you're still making money, right? So you've more than doubled your account. Even after a disaster month, 10 months you're trading this, and then you have a disaster month, you're still more than doubled your account during that 10, 11-month period. So, you have to ask yourself those kind of questions. So that's the process. And this is the same process you use for every single strategy, no matter what it is. I don't care if it's technical analysis based, option spreads, covered calls. You determine what the worst case type scenario is if you go on a horrible losing streak, and you take half of that amount and plug it into the formula. Okay? Then you create your risk table based on whatever that number is, and you do a risk analysis after that. It doesn't matter what strategy you're trading. That is the process. The only question is the variables. Okay, how aggressive, how conservative. Now, earlier I divided the categories into the strategies into two categories: limited risk and unlimited risk. And the reason I did this again was because you have to take into consideration that the unlimited risk strategies have the potential of producing a higher probability of producing a larger maximum expected risk. Therefore, you need to be more conservative with how you analyze those types of strategies when determining how to increase. So even if I'm trading covered calls and I allocate $5,000 to covered calls each week, theoretically my maximum expected risk is $5,000 in that week. If I place 4 covered calls on and all 4 stocks go to zero, then I could lose, my $5,000. Obviously, that's not very probable. But what happens if one does that? Okay, so you have to look at that. If I've done one and I've allocated $1,250 and something horrible happens, it goes bankrupt, I lose, it goes to zero, it's worthless, and I lose what I allocated towards that trade, I lose $1,250 in that position. Is that possible? Absolutely. Still unlikely? Yeah, you're not going to see that very often. Even when a stock goes bankrupt, which we actually experienced recently in a trade. And essentially, we barely lost anything. It still has value. Bankruptcy doesn't mean it goes to zero. So we're talking about absolutely bankruptcy. It's dead. Not unlikely, or not likely. Possible, but not likely. But you could still be looking at risking 25% on that. Then you ask, okay, with covered calls, what is the chance of all 4 losing 10% in 1 week? Well, if you have a stock market crash, that's a very real possibility. So you're looking at that point at a $2,000 loss in that week. You're looking at a 40% drop in your account. So with unlimited risk strategies, you have to take into account the fact that there is the possibility of suffering the larger losses. So you have to be a little bit more conservative. And if you properly take into consideration the larger loss or the larger risk associated with those trades, then you will incorporate that into the money management. Because if we say that, okay, if we lose 40%, however that may happen, if we lose 40%, and that's really a horrible situation of our initial capital, then that's $2,000. Well, that's the number we cut in half. So we cut that in half and we use that as our increase. So it's $1,000, right? So it is bigger. The bigger that number is, the more conservative you're being. But it has to be relative to the strategy that you're trading. If my maximum risk is $10,000 on a strategy and I use $1,000 delta, that's aggressive. If my maximum risk is $1,000 on a strategy and I use $1,000 delta, that's being very, very, very conservative. Okay, so it's relative to what the risk is. But you take that number, you plug it in, same plug-in, and at 6,000 you go to 2. Now, then you bring in another situation. Okay, well, what does it cost to go to 2? Do I have the capital to go to 2? So you have to make sure you have the capital to go to 2, or else you're going to need to use margin. So if at 6,000 you cannot allocate $2,500 on 4 different trades, then you can't increase to 2 like that. So your beginning trade size may be dictated by your account size until it actually grows, or until you get margin, use margin in the account, then that can change things. So those are the only things, the variables from each different strategy that might change how you apply the money management, but the money management strategy itself and the process for going through that strategy is exactly the same. And there's several ways you can do that. You can, instead of going to 4, instead of taking 4, you can just take 2 or 3 covered call positions, for example, a week, and apply the compounding to just 2 or 3 a week as opposed to 4 or 5 a week. So the bottom line is that you need to account for the risk regardless of the strategy you're trading, and then go through the process of creating the increase table and then doing a risk analysis, and then repeat that as often as necessary. Now, one note that I will make, I'll throw out here, personally, I would rather lose 50% of $50,000 than 10% of $20,000. Okay, the end result is $25,000 versus $18,000 after the largest drawdown, or the maximum expected risk. So sometimes, in other words, sometimes being more conservative is actually being more risky. Because at the end of the day, after you suffer that large drawdown, you have an account balance. And if you were conservative because you didn't want to see a larger percentage drop of the profits, but you never saw the extended profits to begin with because you were too conservative, then you're basically being more risky. Okay? Make sure that you take that into consideration. Because after 5 years, if you're more conservative, your account may increase to $200,000 as opposed to $500,000. And I'd be willing to risk half of $500,000 than 20% of $200,000, right? Way far more willing to do that. So that you have to ask that question as you're going through this and saying, okay, if I reach 10 increases, for example, and I drop my account from $18,500 to $12,000, am I good with that? Well, if you're more conservative with the money management, and you suffer the drawdown after only 5 increases, and your account goes from, let's say, $14,000 to $8,000, you're better off being more aggressive with that. So consider that. Everybody's different on what they want and how much they can risk and what they're going to allocate to different strategies and whatnot. So I can't answer those questions for you. I can give you the principles so that you know how to answer those on your own. Now, it's very difficult for me to give everything in such detailed manners, obviously in such a short period of time, so much so that I have a 12-hour money management course available online that goes through these principles inside and out, frontwards, backwards, upside down, right side up, and then some. The course sells for $997, but if you're watching this lesson, you can get the course for $297. I'll just make that for $297 for a limited time. As important as money management is, the better you understand, the more efficiently you will be able to apply it to your trading. Bottom line. So it's my opinion that if a trader understands anything, he better understand money management. Before he understands anything else, he needs to understand money management. If you feel like you understand it enough to be able to properly apply it to the PDS Trader Strategies with this lesson, great. If not, you get a great deal on this 12-hour course. Just go to smarttrading.com, use coupon code PDSMM700, and it will drop the price from $997 to $297 for this group only, and it'll be available for a while. So I'll just throw that out there. I hope you have enjoyed these lessons and that they prove to be highly profitable for you in the years to come. Thank you.